Welcome back to our channel. If you're new, thank you for joining us. My name is Alex Hughes with the North Pacific Homes Group here in Victoria. We've got a great video for you folks today. We're going to be talking to Chris Cavaghan. He's a mortgage broker here in Victoria, and he's one of the first mortgage brokers that I had actually ever met when I first started real estate. And he's going to be going over what his role in the home buying process is and answer some questions that we'd actually pulled from our viewers, and we hope you like it.
All right, everybody, like I mentioned in our intro, I'm very happy to be joined here with Chris Cavaghan, a close personal friend. He's actually the first mortgage broker that I ever met, and he's graced us with his time and is going to answer some questions for us. So, Chris, just again, thank you so much for joining. And the first question I have for you is, who are you and how long have you been doing this?
Good morning. Yeah, my name is Chris Cavaghan. I've been a broker since 2006. Before that, I was doing accounting, so I've had a history of working with numbers pretty much my entire work life. And I work with Dominion Lending Centers under the franchise Modern Mortgage Group.
Okay, amazing. And kind of the first question that I think a lot of people don't really fully are aware of the differences, but what exactly is the difference between yourself as a mortgage broker or a mortgage specialist?
Well, the main difference is lending options. As a broker, we have access to 20 to 30 different lenders, whether they're conventional banks like TD or Scotia, credit unions. There's a big group of monoline lenders that don't have branches. They deal majority through mortgage brokers, the access to B lenders and private lenders as well. So the biggest difference is options. If
Okay.
you're dealing with a bank or a mortgage specialist at that specific bank, you've got their options. That's it. So if you don't fall into their guidelines, now you're on to the next bank, where if you were with a mortgage broker, we do all that work for you.
Okay, amazing. That's fantastic. There's just more options, which is great. The next one is, when I first sit down with my clients, kind of one of the first thing that I try to get done for them is figuring out, of course, what their budget is and getting them pre-qualified or pre-approved. And there is a difference between a pre-qualification and a pre-approval. And what exactly are those differences, and kind of what is the process to get that either pre-qualification or pre-approval?
Well, they are kind of the same. So your pre-approval or pre-qualification is really based on three things: your debt service ratios, your down payment, and your credit. So if all three of those things are in line, then you are pre-qualified. So when you talk about getting a pre-approval, it's more or less a rate hold. So once you have all those three things satisfied, we would submit to a lender to get you a rate hold that lasts 120 days. After that 120 days is up, you still are pre-approved unless anything major has happened with your income to change the debt service ratios. You have less down payment or something has happened with your credit. Your pre-qualification doesn't change. What changes is the rate, possibly, which changes the qualifying rate, which could potentially change your mortgage number a little bit. But the being pre-qualified or getting pre-approved isn't a full pre-approval because the lenders don't look at the whole deal unless there's a live contract.
Right.
They
So
just look at those three basic things: credit, down payment, and debt service ratios. And
okay.
if all those are in line, you're pre-approved.
Yeah. So essentially kind of what you're saying is, although we do have a pre-approval in place, and this is something that I have a conversation with my clients is, and especially if we're not going into a multiple offer situation, it is very important that we still get that subject to financing, because of course the banks or the lender still needs to approve the actual property itself.
Absolutely, yes.
Yeah.
There's a
Okay.
couple things. The property is the biggest thing. You never know if it's been flagged or if there's anything wrong with it. But there also could be things in your employment that when the lender does a verbal verification, it might not be as exact as what's written in the letter. So it's always good to just make sure everything is dealt with during that subject to financing clause.
Perfect. And a little case study for my own personal experience was, we had a client that was well within their budget, well within their pre-approval, but the property was flagged by lenders for having structural issues, so they couldn't actually lend on the property. So utmost importance, although you are pre-approved, even if we're hundreds of $1,000s under that pre-approval, We want to make sure that we get that condition of financing and make sure that the lender is actually comfortable with the property.
Yeah, the less risk, the best.
Exactly, right? Now, obviously, if you have been following real estate, there is talk daily of what's going on with Bank of Canada, interest rates, all of that stuff. And I think there is a little bit of not a miscommunication, but maybe not a full understanding of exactly what the Bank of Canada interest rate overnight policy means. And essentially, you have two different options that you can look at. You can look at a variable rate mortgage or a fixed rate mortgage. Can you kind of go through what the differences are? I mean, names are pretty self-explanatory, but kind of what are the main differences and what are they based off of?
Fixed rate mortgages have a set rate that doesn't change. So you can take 1, 2, 3, 4, 5, 7, or 10-year terms. Those are the safe bets. You don't have to worry about any changes. The variable rate mortgage, there's two types of those. One is a payment that fluctuates when the Bank of Canada changes prime rate, and the other is where the amortization changes, but your payments stay the same. So if you're in a situation where rates are rising, your payment won't change, but your amortization will get longer. So there is a risk with rates increasing, but there's a benefit when they're decreasing. So the variable is more like a risky stock. The fixed rate is more like the safe stock.
Mhm. Okay. And what are those two based off of?
The variable rate is based off of the bank's prime lending rate, which they
Hmm.
base off the Bank of Canada's lending rate.
Right.
The fixed rates are based off of the Canadian bond yields. So those
Okay.
fluctuate nonstop. So even though prime could be holding steady for months and months and months, the bond yields could be going up and down and fixed rates could be fluctuating.
Right. Okay. And like Chris had mentioned, when you look at the historical averages, on average, and correct me if I'm wrong, variable tends to be lower than fixed rate. However, obviously, if you've bought your house in the last couple of years, especially at the beginning of 2022, and you did go variable, obviously you got hit with astronomical increases, and we've seen them come back down as well. So again, it's like Chris had mentioned, it's the amount of risk that you're willing to take. If you're comfortable with variable fluctuating or your payments fluctuating, it could be an option for you. But if you want to know exactly what's coming out of your bank account every month, like if you have a car payment, let's say, fixed rate's probably the way that you want to go. For first-time home buyers or people that are maybe relatively new to the home buying process or haven't bought in a while, are there any kind of incentives that people should be looking at?
There's a couple, yes. So Canada's increased the amount that you can borrow from your RRSPs interest free.
Mhm.
So you can take those out as an interest-free loan to yourself. And you, a first-time buyer in that situation is not necessarily the first time ever. It's that if you haven't owned a home in 4 years or you haven't lived in a home that your spouse owns, so you can withdraw those RSPs and you have 15 years to pay it back.
And what's that amount? Sorry?
It's up to 65,000 now.
65,000. Okay.
Yeah.
Perfect.
The second thing is the property transfer tax, which is pretty hefty. So up to $850,000 if you are a first-time buyer ever, you can't ever have owned a home, then you would qualify for that exemption.
Mhm.
And there's also exemptions for brand new builds up to 1.1 million. And those are the two main things that you for first-time buyers. When it comes to the debt service ratios and things like that, they're all the same. The CMHC last December came out with a new rule that if you're a first-time buyer or you're buying a new home, you can extend your amortization back up to 30 years, which normally was only for conventional mortgages if you had 20% down.
Right. Right. Okay. That's fantastic. And I mean, the goal obviously is to pay the least amount of taxes possible for a home. So that's really nice to hear. Earlier, you had mentioned obviously as a mortgage broker, you have access to a variety more options and lenders than a mortgage specialist that's only dealing with the bank. Are there any kind of main differences between going with like a big five bank, a TD Scotia, or versus a credit union?
The biggest differences are the way that they treat rental income, whether it's the suite income or non-subject rental properties. So there's every bank has their own different spreadsheet that we can use rather than them adding the income to your income or using a rental offset. It gets a little bit convoluted, but since every bank has a little bit different rules, then sometimes you just have to find the bank that suits the client's needs.
Okay, perfect. And is historically, if you know this just off the top of your head, are there any, do either credit unions or banks generally have better rates?
Actually, it fluctuates. Right
Okay.
now, the credit unions have the lowest rates,
Hmm.
and the big banks are actually quite high, almost 0.5% more.
Oh, interesting.
The monolines are sitting in the middle.
Okay.
Normally, the model lines have lower rates. They don't have the overhead of branches and
Right.
tellers and all that kind of stuff. So
Right.
they're usually able to offer a little bit lower rates. But you will get in situations where the banks are a bit aggressive. They want to get some mortgages out. So they drop their rates to a level that everybody goes to them.
Right. Okay. Okay. Very good. As a realtor, we're technically self-employed. What is the main difference of getting that pre-qualification for, a self-employed individual versus a salaried employee?
Well, the salaries is easy. You just normally need a letter of employment and a current pay stub to make sure that it is that you are getting paid the same amount every month.
Right.
Self-employed is a little bit different because there's a lot of paperwork. So we need to use a 2-year average of income. That is tax returns. If you're incorporated, we need the financial statements. If you're a sole proprietor, then we use the statement of business activities in your T1 generals. And some lenders allow you to add back certain non-cash expenses. Some lenders don't. And again, that is comes down to the options that are available and whatever situation we need for that specific client is which lender we will use to make it work.
Right. Okay. And so a little, personal story for my situation and for the self-employment. When I first got licensed, my wife and I had a couple of really good years. We were able to buy a house in the first kind of 18 months of myself getting licensed. So I had the down payment, I had the income, but I didn't have the 2 years of self-employment. So I actually had to ask mom and dad to co-sign on it in order to get that guarantee. So although you might have, if you're a relatively new self-employed individual and you might have all the income and the payment and all that stuff, if you do not have those 2 years of self-employment, unfortunately, you're not going to be able to get financing.
Exactly. Yeah. You
Yeah.
need your 2 years, the tax returns.
Right.
If you are in the same line of work, then sometimes lenders will look at your previous history,
Okay. Yep.
understanding that you are going out on your own to make more money. So,
Yep.
in situations like that, sometimes you can use a 2-year average based on a little bit of employment income and then your year and a half of self-employed income.
Right. Okay. Good to know. You touched on this briefly, kind of with the credit unions and the differences, but if you're looking to purchase an investment property, whether it's a condo or whether it's a multi-unit, I'm sure even those will have the discrepancies there. But how do those mortgages work, and how's the approval process different?
It's not too much different. Basically, the same things: the debt service ratios, the down payment, and the credit. However, with a investment property, CMHC does not insure those, so you have to have 20% down.
Okay.
That's the main thing.
Okay.
So if you qualify with 20% down based on that lender's rental offsets or how they calculate their rental income and your credit's in line, then the same thing, you would be pre-approved for that.
Right. Okay. Amazing. And the final question I have for you, obviously people want to try to pay down their mortgage as fast as possible. Nobody
Right.
likes having this big debt. When I'm looking in my bank account, I just see a massive, money owed.
Yeah.
Are there any recommendations that you can make to help buyers pay off their mortgages the
Yeah,
fastest?
absolutely. So the main way is paying biweekly. If you do accelerated biweekly, you take your monthly payment, you divide that by two, and then every year there's 2 months that you have three payments. So basically, you're paying an extra month per year. If you're paid biweekly, this is very convenient. If
Hmm.
you are paid monthly, you can do the same thing by paying monthly, but every year make a lump sum payment of 1 month. And so your annual payments will be the same as the biweekly. You'll pay down the amortization almost as quickly.
Right.
You can increase that to weekly. There's a small difference, just compounding, and that helps as well. But
Right.
you're also allowed to pay every lender is 15%, but most are 20% of the original balance per year without penalty. So a $500,000 mortgage, you technically could put 100 grand down every year and have the mortgage paid off in 5 years with no penalty.
Oh wow.
Obviously, if
Okay.
you have the means.
Yeah, exactly. If you're able to, yeah, yeah, that's fantastic. All right, and that's all the questions I had. Chris, thank you so much for your time. For those of you that are watching, I hope this was informative for you. We're going to link Chris's information down below if you have any questions or you're thinking about making a move or your first move, whether you're looking to refinance even. Chris, I cannot speak highly enough about. He's helped me out with a variety of my own clients. So again, thank you, Chris, so much for taking the time today, helping out buyers here. And is there anything else that you'd like to say before we sign off?
No, I appreciate you for having me, and it was great talking to you.
Yeah, amazing. All right.
Thanks a lot.